June 2002, Clinton, Mississippi, 3 in the morning. Cynthia Cooper stared at her computer screen in the empty WorldCom headquarters. The building's heating system clicked and hummed in the silence. Outside her office window, the parking lot stretched dark and vacant. She'd been staring at the same accounting entry for 20 minutes. Capital expenditure account 47821. A transfer of $1.4 billion labeled with 2 words that made no sense whatsoever. Prepaid capacity. She'd been an accountant for 15 years. She'd audited telecommunications companies, manufacturing firms, tech startups. She'd reviewed thousands of financial statements, and she had never once heard the term prepaid capacity. Not in any textbook, not in any conference, not in any conversation with another accountant. It wasn't that the term was wrong, it was that the term didn't exist. Someone had made it up, and they'd used it to move $1.4 billion. But this wasn't even why she was here at 3 in the morning, working in secret, telling no one in her department what she was investigating. It was what happened when she asked about it. When she'd mentioned the term to the corporate finance director earlier that week, he'd looked at her blankly, then referred her to the controller. When she'd asked the controller, he'd stammered, avoided eye contact, and sent her to someone else. When she'd approached the head of property accounting, he'd claimed he'd never heard of it either, despite the fact that his digital signature was on 17 separate prepaid capacity entries. And when she'd mentioned to her boss that she wanted to audit the capital expenditure accounts, the company's CFO had personally called her, at night, at home, to tell her she was wasting company resources, that she should focus on other priorities, that this audit wasn't necessary. A CFO doesn't call a mid-level internal auditor at home to tell them to stop an audit, not unless that auditor is looking at something they're not supposed to see. Cooper opened a new spreadsheet and began building what accountants call a T account, a simple visual tool, debits on one side, credits on the other. She started pulling every transaction labeled prepaid capacity. The first entry appeared in Q2 of 2001, then another, and another. They were all structured the same way. Money moving from the income statement, where operating expenses are recorded, to the balance sheet where capital assets are recorded. It's a subtle distinction, but it's the difference between reporting a loss and reporting a profit. Operating expenses hit your bottom line immediately. Capital expenses can be spread out over years. If you're a telecommunications company and you're losing money because your costs are higher than your revenue, you have 2 options. Cut costs, or lie about where those costs go. WorldCom, the second largest telecommunications company in America, a company worth $186 billion at its peak, a company that employed over 80,000 people, had chosen the second option, and Cooper had just found the evidence. Before we go any further, you need to understand something. What you're about to hear isn't a story about numbers. It's a story about what happens when one person finds a crack in a system that wasn't supposed to have any cracks, and what happens when they decide not to look away. Because when Cooper discovered that $1.4 billion, she'd only found the beginning. The full fraud was $11 billion, the largest accounting fraud in American history at that time. And it almost didn't get caught, because the people who committed it were the same people who were supposed to prevent it. The executives, the CFO, the CEO, the people everyone trusted. This is Quiet Collapse, where we tell the stories of hidden disasters that almost destroyed everything, and the invisible people who stopped them. If you want to understand how the systems you trust every day are one bad decision away from catastrophic failure, subscribe now. Share this video with someone who thinks the numbers don't lie, because by the end of this story, you'll realize that numbers lie all the time, when the people in charge want them to. Cooper's story begins long before that night in June 2002. She grew up in Clinton, Mississippi, a small town whose biggest claim to fame was being the headquarters of WorldCom. It was a Cinderella story. A telecommunications company rising from a small regional provider to a global powerhouse. For a state that was consistently ranked as one of the poorest in America, WorldCom represented hope. Jobs, economic growth, pride. Cooper's parents were proud when she got hired at WorldCom in the mid-1990s. It meant stability, It meant she'd made it. By 2002, she was Vice President of Internal Audit. Her job was to examine the company's internal processes, identify risks, ensure compliance. It was the kind of position that required trust. Management had to believe you were there to help the company, not hurt it. But Cooper was about to learn that sometimes helping the company means hurting the people running it. The first warning sign came from an unexpected source. Kim Emmy, a budget analyst in WorldCom's Network Systems division. Emmy had noticed something strange back in December 2000. He'd been told to reclassify labor expenses as capital expenditures, not because the work itself had changed, just because the company needed to hit its earnings targets. When Emmy questioned the order, he was told to mind his own business. When he escalated it to the COO, the order was quietly cancelled. And then, shortly after, Emmy was fired. But Emmy didn't stay quiet. He wrote about what he'd seen. And eventually, that article made its way to Glyn Smith, one of Cooper's internal audit managers. Smith brought it to Cooper's attention in May 2002, suggesting they move up their scheduled capital expenditure audit. Cooper agreed. She had no idea what they were about to find, or what it would cost her. The audit started quietly. Cooper and her small team began reviewing capital expenditure accounts, looking for irregularities. That's when they found it. The first entry labeled prepaid capacity, then dozens more, then hundreds. All of them moving expenses from operating costs to capital assets. All of them with no supporting documentation, no invoices, no receipts, no contracts, nothing. Just transfers of massive amounts of money with a made-up term attached. Cooper knew immediately what this meant. This wasn't a mistake. This wasn't an accounting error. This was fraud. Deliberate, systematic, coordinated fraud designed to hide the fact that WorldCom was losing money. But knowing it and proving it are two different things. And proving it meant going up against some of the most powerful people in the company. Cooper requested a meeting with Scott Sullivan, WorldCom's CFO. Sullivan was a Wall Street darling, brilliant, charismatic, the man who'd convinced CEO Bernie Ebbers to acquire MCI and transform WorldCom into a telecommunications giant. He was also the person Cooper needed to confront. But Sullivan didn't want to meet. He didn't want to explain. Instead, he did something that confirmed Cooper's worst suspicions. He tried to stop the audit. Sullivan sent emails to Cooper questioning why she was wasting company resources on this investigation. He told her team they were tying up employees who were needed elsewhere. He personally called her to suggest she focus on other priorities. When Cooper persisted, he became hostile. He tracked her down outside the office, confronted her in parking lots, demanded to know why she was questioning the company's accounting. Cooper's mother had once told her something she never forgot. Don't ever allow yourself to be intimidated. So she didn't stop. She went deeper. Cooper and her team started working at night. They couldn't risk anyone knowing what they were investigating during business hours. Sullivan had eyes everywhere, so they came in after everyone left, worked in the dark, used only the computers they controlled. They went door to door in the accounting department, questioning people. Most claimed they'd never heard of prepaid capacity. Some looked terrified when asked about it. Others deflected, referred Cooper to someone else, or simply refused to answer. Finally, Cooper confronted David Myers, WorldCom's controller, the man whose signature appeared on many of the fraudulent entries. And Myers broke. He confessed. He told Cooper that Sullivan had ordered him to make the entries, that he'd known they were wrong, that he'd done it anyway because Sullivan was his boss, and he didn't think he had a choice. Myers later told the Wall Street Journal that when Cooper confronted him, he felt a sense of relief, that he'd been carrying the weight of the fraud for months, and finally, someone was asking him to tell the truth. But the confession didn't make things easier for Cooper. It made them harder, because now she knew with certainty that the fraud went to the very top of the company, and she had to decide what to do about it. She could report it to the board, risk losing her job, risk retaliation, risk being blamed for destroying the company that her hometown depended on, or she could stay quiet, pretend she'd never seen anything, let the fraud continue, Let someone else discover it eventually. It wasn't really a choice, but it felt like one. Cooper called Max Bobbitt, a member of WorldCom's board and chairman of the audit committee. She explained what she'd found: the prepaid capacity entries, the lack of documentation, Meyer's confession. Bobbitt told her to consult with KPMG, WorldCom's external auditor. Cooper did. KPMG confirmed what she already knew. There was no justification under generally accepted accounting principles for these entries. They were fraudulent. On June 20, 2002, Cooper presented her findings to the full audit committee. She'd found $3.8 billion in fraudulent entries. Entries that had turned massive losses into reported profits. Entries that had misled investors, regulators, and employees about the true financial state of the company. The board gave Sullivan the weekend to explain himself. He wrote a white paper attempting to justify the entries. It was unconvincing. On June 25, 2002, WorldCom admitted publicly that it had overstated its earnings by $3.8 billion. The stock price collapsed. The company filed for bankruptcy, and Cooper's life changed forever. But the $3.8 billion wasn't the full story. As investigations continued, the fraud grew. $5 billion, $7 billion, $9 billion. Eventually, the total reached $11 billion, the largest corporate fraud in American history at that time. More than 30,000 people lost their jobs. Investors lost over $180 billion. The company that had been the pride of Mississippi became a cautionary tale about corporate greed and unchecked power. Bernie Ebbers, WorldCom's CEO, was sentenced to 25 years in federal prison. Scott Sullivan pleaded guilty and received a shorter sentence in exchange for testimony. David Myers and other executives also pleaded guilty, but the damage was done, not just to WorldCom, to the entire economy. Because WorldCom wasn't alone. Just months earlier, Enron had collapsed under similar circumstances. Massive accounting fraud, executives lying to investors, auditors failing to catch it. The public was losing faith in corporate America. Congress had been considering passing stronger regulations after Enron, but they'd hesitated. Maybe Enron was just one bad apple, one company run by uniquely corrupt executives. WorldCom proved them wrong, and that's when Congress acted. The Sarbanes-Oxley Act of 2002 fundamentally changed corporate governance in America. It made executives personally liable for the accuracy of financial statements. It required companies to establish anonymous whistleblower channels. It strengthened the independence of corporate boards. It enhanced penalties for white-collar crime. Section 404 of the Act, which requires companies to assess and report on their internal controls, was added specifically because of WorldCom. Before WorldCom, CEOs could claim ignorance about what was happening in their finance departments. After WorldCom, they couldn't. The law made it clear. If the numbers are wrong, the person at the top is responsible. And Cooper's role in exposing the fraud made her a national figure. Time magazine named her one of 3 Persons of the Year in 2002, alongside Sharon Watkins of Enron and Colleen Rowley of the FBI. 3 women, 3 whistleblowers, 3 people who'd chosen to tell the truth when it would have been easier to stay silent. But let's talk about what that choice actually meant for Cooper, because the public story, the hero story, the Time magazine cover, that's not the whole picture. After WorldCom's collapse, Cooper stayed with the company, helping it emerge from bankruptcy as MCI. She worked for 2 more years, assisting with the restructuring, ensuring the new management was legitimate. But her life was never the same. She received threats. People in her community blamed her for destroying WorldCom, for costing 30,000 people their jobs, for ruining the company that had been Mississippi's economic engine. Never mind that she hadn't committed the fraud. Never mind that she'd only exposed it. In the minds of some, she was the problem. She was interviewed by Congress, questioned by the SEC, deposed in lawsuits. Her personal life became public. Her every decision scrutinized. She became a symbol. And symbols don't get to be human. Years later, Cooper wrote a book about her experience. Extraordinary Circumstances, The Journey of a Corporate Whistleblower. In it, she described the psychological toll of whistleblowing, the isolation, the second-guessing, the nights wondering if she'd made the right choice, the fear that maybe she'd misunderstood something, that maybe there was an explanation she'd missed, but there wasn't. The fraud was real. The deception was real. And if she hadn't acted, it would have continued. The collapse would have been worse, more people would have lost more money. But knowing you did the right thing doesn't make it easier. It just makes it necessary. Let me tell you what makes Cooper's story particularly important. It's not just that she found the fraud. Lots of people could have found it. The external auditors should have found it. The board should have caught it. Regulators should have noticed. But they didn't, because they weren't looking, or because they didn't want to see. Cooper found it because she was doing her job, not the job as it was described in her title, but the job as it should be done. Asking questions that made people uncomfortable, following leads that went nowhere, refusing to accept explanations that didn't make sense. That's what internal audit is supposed to be, not a rubber stamp, not a formality, but a genuine check on power. A defense against the natural human tendency to cut corners, to rationalize, to convince yourself that the ends justify the means. And here's what's terrifying. WorldCom's fraud wasn't sophisticated. It wasn't some complex derivative scheme or off-balance sheet entity that required a PhD in finance to understand. It was simple. Move expenses from one category to another, call it prepaid capacity. Hope nobody asks what that means. That's it. That was the whole scheme. And it worked for years, because people didn't ask, because employees trusted management, because external auditors assumed the numbers were right, because regulators were overwhelmed and underfunded, because everyone involved had an incentive not to look too closely. Investors wanted their stock price to keep rising. Employees wanted their jobs to be secure. Executives wanted their bonuses. Auditors wanted their fees. And so a company built on debt, struggling to compete in a market it didn't understand, was able to lie about billions of dollars in losses, until one person found a number that didn't make sense and refused to ignore it. Cooper's story raises uncomfortable questions. Questions about how we structure our economy, about how much power we give to executives, about whether the incentives we create, bonuses tied to stock prices, careers dependent on quarterly earnings, actually encourage fraud rather than preventing it. Because Sullivan wasn't an evil person. By all accounts, he was brilliant, hard-working, loyal to the company. He believed he was helping WorldCom survive a difficult period. He convinced himself that the fraud was temporary, that once the market recovered, they'd fix the books and no one would be hurt. That's how fraud happens. Not because people wake up and decide to be criminals, but because they convince themselves that what they're doing isn't really fraud. It's just creative accounting, just flexibility, just doing what needs to be done to keep the company alive. Until the lie becomes too big to fix, until the only choice is to keep lying or admit everything. And most people, faced with that choice, keep lying. This is why Cooper's decision matters. Not because she was uniquely ethical, but because she was willing to act on what she knew was wrong, even when it was hard, even when it cost her, even when it would have been so much easier to look away. That's the choice that every person in a position of responsibility faces at some point. Not a dramatic choice, not a movie moment, just a quiet decision to either follow up on something that doesn't make sense or decide it's not your problem. Cooper followed up, and it changed everything. Let's talk about prepaid capacity one more time, because I want you to understand just how absurd this was. Imagine you run a business, you have expenses, rent, salaries, equipment, utilities. These are costs that hit your income statement every month. They reduce your profit. Now imagine you're losing money. Your costs are higher than your revenue. Your stock price is falling. Investors are getting nervous. So you come up with an idea. What if we just move some of these costs off the income statement? What if we call them capital investments instead of operating expenses? What if we say we're building long-term value rather than spending money? It's the same money, the same costs. But now they don't count against your quarterly profits. Now you can report earnings growth instead of losses. Now your stock price goes up instead of down. Now you keep your job. Now you get your bonus. All you have to do is move the numbers from one account to another and come up with a term that sounds official enough that nobody questions it. Prepaid capacity. Sounds legitimate, doesn't it? Sounds like something a telecommunications company might actually need. Sounds like the kind of technical term that you wouldn't expect everyone to understand. That's the genius of the fraud, and that's also why it failed. Because accounting has rules, and those rules exist for a reason. When you call something a capital expense, you need to be able to prove that you're actually building a long-term asset. You need invoices, contracts, documentation showing what you bought and why it's valuable. WorldCom had none of that, because they weren't building anything. They were just moving numbers around, hoping nobody would notice, and for a while, nobody did, until Cooper found that first entry at 3 in the morning, and everything unraveled. That's the thing about fraud. It's not sustainable. Eventually, someone asks the wrong question, or the right question depending on your perspective. Eventually, the numbers stop adding up. Eventually, the lies catch up to you. The only question is whether that happens before or after the company collapses. Before or after people lose their savings. Before or after employees lose their jobs. Cooper made sure it happened before. Not soon enough to save WorldCom, but soon enough to limit the damage. Soon enough to expose the fraud while people could still do something about it. Soon enough that the executives responsible could be held accountable. And that accountability matters, because Ebbers didn't just lose his job, he went to prison. For 25 years, he died in prison in 2020, never having fully served his sentence. Sullivan spent years in federal prison. Myers served time. Other executives faced consequences, not because Cooper wanted revenge, but because fraud has victims. Real people who lost real money, employees who lost their jobs and their retirement savings, investors who trusted that the numbers they were seeing were real, communities like Clinton, Mississippi, that depended on WorldCom for economic stability. Those people deserved justice, and they got it, not because the system worked automatically, but because one person decided to do their job, to ask uncomfortable questions, to follow the evidence wherever it led, even when it led to the CFO, even when it led to the CEO, even when it meant becoming a whistleblower. Let me tell you what happened after Cooper blew the whistle, because this is where the story gets complicated. WorldCom filed for bankruptcy in July 2002. It was the largest bankruptcy in American history at that time. The company emerged from bankruptcy in 2004 under a new name, MCI. The rebranded company struggled for years before finally being acquired by Verizon in 2006. Thousands of employees who lost their jobs never got them back. The economic impact on Mississippi was devastating, and Cooper, who had exposed the fraud, became a controversial figure. Some people saw her as a hero: Time magazine, Congress, the SEC. They recognized that she'd done the right thing. But others saw her as a traitor, the person who destroyed WorldCom, the person who cost their community its largest employer, the person who made them lose their jobs, their savings, their pride. And Cooper had to live with that. She had to walk around her hometown knowing that some people blamed her. She had to explain to her children why their mom was on the news, why strangers were saying mean things about her, why life had become so complicated. This is the reality of whistleblowing. It's not clean, it's not simple. You don't get to be the hero without also being the villain in someone else's story. But here's what Cooper would tell you, and she has told this story in her book, in interviews, in speeches to students and professionals. She'd do it again. Because the alternative was watching the fraud continue, watching more people get hurt, watching the collapse happen on an even larger scale, and she couldn't live with that. She couldn't look at those entries, know they were fraudulent, and pretend she'd never seen them. Not because she was brave, but because she couldn't live with herself if she stayed silent. That's not heroism. That's just basic human decency. But in a system where staying silent is easier, where speaking up has consequences, where doing the right thing can cost you everything, basic human decency starts to look like heroism. And maybe that's the problem. Maybe we've built systems where telling the truth requires courage rather than being the baseline expectation. Maybe that's what needs to change. WorldCom isn't the only company where this has happened. Enron collapsed from similar fraud. Tyco, Health South, Adelphia, Parmalat. The list goes on. Companies where executives lied, where accountants helped them lie, where auditors failed to catch it, where regulators arrived too late. And in almost every case, someone inside the company knew. Someone saw the numbers that didn't make sense. Someone questioned the accounting. And most of the time that person stayed quiet. Because speaking up is hard. Because whistleblowers rarely have happy endings. Because the system doesn't protect people who challenge authority. Because it's easier to assume someone else will deal with it. Because you can convince yourself it's not really fraud. Just aggressive accounting. Just pushing the boundaries. Just doing what everyone else is doing. Until you're the one holding evidence of an $11 billion fraud. And you have to decide whether to report it or destroy it. Whether to protect the company or protect the truth. Whether to keep your job or keep your integrity. Cooper chose integrity. And it cost her, not everything. She didn't go to prison. She didn't lose her career. She went on to become a consultant, a speaker, an advocate for corporate ethics. But she lost her anonymity. She lost the simple pleasure of going to work, doing her job, and going home without the weight of national attention. She lost the ability to trust that the people around her had her best interests at heart. She gained wisdom. She gained perspective. She gained the knowledge that she'd done something genuinely important, but she also gained the burden of being a symbol, of representing something larger than herself, of being the person people point to when they talk about whistleblowers, about fraud, about corporate ethics. And that's a heavy thing to carry. I want to circle back to that night in June 2002, Cooper sitting in her office at 3 in the morning, staring at a screen full of numbers that shouldn't exist, because that's the moment that matters. Not the congressional testimony, not the Time magazine cover, not the Sarbanes-Oxley Act, but the moment when one person decides whether to follow a lead or drop it, whether to ask the next question or let it go, whether to risk everything or play it safe. That's the moment when quiet collapses get prevented, or when they get ignored. And the difference between those two outcomes is often a single person making a single choice. Not because they're special, not because they're uniquely qualified, but because they're paying attention and they're willing to act on what they see. That's all it takes, attention and action. But those two things, in combination, in a system that discourages both, are revolutionary. You've made it this far, and if you're still watching, you understand something important. The systems that hold our economy together, the systems that protect your savings, that process your paycheck, that value the companies in your retirement account, they're not automatic. They're not foolproof. They only work because people like Cooper do their jobs. Think about this. Right now, someone at a major corporation is staring at numbers that don't make sense, making the same choice Cooper made. Do they dig deeper? Do they risk their career? Do they become the person who exposes fraud, or do they look away? That choice is happening today, tomorrow, every single day. And whether they choose to act determines whether we read about the next massive fraud in the headlines, or whether it gets stopped quietly, invisibly, before it destroys lives. This is Quiet Collapse. If you haven't subscribed yet, do it now. Hit that notification bell, because we're going to keep telling these stories. The invisible heroes, the quiet decisions, the moments that prevent catastrophes you never hear about. Share this with someone who needs to understand how fragile these systems really are. And stay with us until the end, because what happens next in Cooper's story, the personal cost, the impossible choices, the aftermath, that's where the real lesson is. Cooper's story is about accounting, but it's not really about numbers. It's about truth, about power, about the systems we build to check that power, and what happens when those systems fail. About the people who stand in the gap when institutions fail. About the cost of doing the right thing and why people choose to pay it anyway. It's about the fragility of trust and how quickly it can be destroyed. It's about the difference between legal and ethical, between technically correct and actually honest, between following orders and following your conscience. These are questions that accountants face, but they're also questions that every person faces at some point in their professional life. When you see something wrong and you have to decide whether to speak up. When you know the truth and you have to choose whether to tell it. When you understand that staying silent is safer but speaking up is right, what do? Most people stay silent, not because they're cowards, but because they're human, because they have mortgages and families and careers to protect, because they don't want to be the whistleblower, because they've seen what happens to whistleblowers, and they don't want that to happen to them. Cooper understood all of that. She was terrified. She questioned herself. She wondered if she was overreacting. She hoped someone else would step in and make the decision for her, but nobody did, and so she made the only choice she could live with. She reported the fraud. And everything changed, not just for her, but for corporate America, for accounting standards, for how companies are governed, for how seriously we take financial reporting, for what we expect from the people in charge, because WorldCom proved that you can't just trust executives to tell the truth. You need systems. You need oversight. You need auditors who actually audit. You need boards who actually govern. You need regulators who actually regulate. And you need people like Cooper, who when they find something wrong refuse to look away. That's the lesson of WorldCom. Not that fraud happens. We already knew that. But that fraud gets stopped by people who are willing to stop it. By people who do their jobs even when it's inconvenient. By people who ask questions even when they're told not to. By people who follow the evidence even when it leads somewhere uncomfortable. By people who choose truth over ease, integrity over security, justice over silence. That's what made Cooper's decision matter. Not because she was perfect, but because she was present. She saw what was happening, and she acted. And that's available to any of us. Not all of us will find an $11 billion fraud, but all of us will face moments where we know something is wrong, and we have to decide whether to do something about it. Whether to speak up in a meeting when someone lies, whether to report a colleague who's cutting corners, whether to question a decision that doesn't make sense. Those aren't dramatic moments, they're quiet ones, but they add up. They create cultures where fraud is less likely to happen, where people know they'll be caught if they lie, where truth matters more than appearances. And sometimes those quiet moments of integrity prevent quiet collapses, disasters that would have happened but didn't because someone paid attention, because someone cared enough to ask questions, because someone was willing to risk something to do the right thing. You won't read about those disasters in the news because they never happened, because someone stopped them before they became headlines. That's what this channel is about. The invisible work, the unglamorous decisions, the people who prevent catastrophes that you never hear about. Because the best outcome is the one where nothing goes wrong, where the fraud gets caught before it destroys the company, where the weakness gets identified before it causes a collapse, where the lie gets exposed before it becomes a disaster. That only happens when people do their jobs, not the minimum required, but the job as it should be done, with integrity, with diligence, with courage when courage is needed. Cooper didn't want to be a whistleblower. She wanted to be an accountant, to do her job, to raise her children, to live a normal life. But she found something that couldn't be ignored, and so she became something more. Not because she wanted to, but because circumstances demanded it, and she rose to meet them. That's what makes her story important. Not that she was extraordinary, but that she was ordinary, a person with a job who did it well, who took seriously the responsibility that came with her position, who understood that being Vice President of Internal Audit meant actually auditing, actually checking, actually questioning, even when, especially when, that made people uncomfortable. Because if internal audit doesn't ask the hard questions, who will? If the people whose job is to find fraud don't look for it, why would anyone else? WorldCom's collapse was preventable. The fraud was obvious to anyone who looked closely. The prepaid capacity entries had no documentation. The accounting didn't follow GAAP. The numbers didn't make sense. But nobody looked, except Cooper. And that's the tragedy. Not that fraud happens, but that it continues. Not that people lie, but that other people let them. Not that systems fail, but that we don't fix them until the failure becomes catastrophic. We wait for the collapse. We wait for the scandal. We wait for the whistleblower. Instead of creating systems where whistleblowing isn't necessary, where fraud gets caught automatically, where internal controls actually work, where boards actually govern, where auditors actually audit, where executives know they can't lie because they'll be caught. That's the world Sarbanes-Oxley tried to create. Stronger internal controls, greater accountability, real consequences for fraud. And it helped. The rate of accounting fraud has decreased since 2002. Not eliminated, but reduced. Because now executives know there's a price for lying. Now boards know they can't just trust management. Now auditors know they'll be held accountable if they miss fraud. Now employees know they can report wrongdoing without automatically destroying their careers. Those changes matter. They save lives. They protect savings. They prevent collapses. And they exist because Cooper did her job. Because she found a number that shouldn't exist. And she didn't stop until she understood what it meant. This is Quiet Collapse. If this story made you think differently about how corporations operate, about how fraud happens, about what it takes to stop it, subscribe to this channel. Share this video with someone who thinks the numbers don't lie, because numbers do lie, all the time. When the people in charge want them to, the only defense is people like Cooper who refuse to accept lies, who dig deeper when something doesn't make sense, who prioritize truth over comfort, who understand that their job isn't to make executives happy, it's to protect the company from those executives when necessary. Drop a comment. What would you have done in Cooper's position? If you found evidence of fraud at your company, would you report it? Would you risk your career, your safety, your reputation? These aren't abstract questions. These are questions that real people face in real jobs. And the answer matters. Because the next WorldCom is out there right now. The next massive fraud. The next corporate collapse. The next scandal that will destroy thousands of lives. And maybe, just maybe, there's someone inside that company who's starting to notice something that doesn't make sense. A number that shouldn't exist. An entry without documentation. An explanation that sounds official but means nothing. And that person is deciding right now whether to dig deeper or let it go. Whether to ask questions or stay quiet. Whether to be Cooper or be silent. Let's hope they choose to dig deeper. Let's hope they ask the questions. Let's hope they're willing to be uncomfortable. Because that's how quiet collapses get prevented. One person, one question, one decision. That's all it takes. But it's everything. Thank you for watching Quiet Collapse. Stay curious, stay skeptical, and never ignore a number that doesn't make sense, because sometimes that number is the thread that unravels everything, and someone needs to pull it.